The focus of today's show is Elon / Tesla versus the sharks of Wall Street. We're in beautiful Tampa Bay. You'll notice behind us a number of dead fish, and that's driven by red tide in effect right now. So some of the birds will eat it, some won't. So you'll see a lot of activity behind us. Also want to note our rig here does look a little strange, but the goal is to get the best sound quality we can. This is Greg for Teslafaninsight. I want to thank our Patreon supporters. Your presence is everything in terms of the viability of the show and is greatly appreciated. We also want to thank those of you who choose to like and subscribe if you enjoy the show. So, yesterday we did a show, or we posted a show, and he discussed the fact that there can be things that happen with sharks and how the sharks might work to attack sort of smaller investors. So the metaphor we were using is the whole idea that there are sharks that feed on fish. So in the water behind us right now, there are certain groups of fish that are targeted by certain groups of sharks, and those sharks will sort of track them down and kill and eat. Well, there's also this phenomenon where sharks have the ability to smell blood, even if the wounded animal or entity is as long away as half to 3/4 of a mile, but still in the water. So one of the phenomenons that we were discussing yesterday is the fact that when sharks go out and start sort of a feeding frenzy, one of the problems that can happen is that those sharks are supposed to eat the small fish, but during that feeding frenzy, on occasion, sharks will actually get wounded by other sharks trying to feed on the fish that are available. And when a shark is wounded, it emits blood, and then that blood can result in all the other sharks stop feeding on the fish and feed on the shark that's been now wounded. So we kind of brought this idea up to how it would apply here in terms of the sharks versus Elon Musk and company. So probably the most famous situation of this sort is there's a company called Long-Term Capital Management. So there are a couple of Nobel laureates and some of the best traders on Wall Street about 15 or 20 years ago that got into a situation where they were given billions of dollars to trade. And they were using certain sort of trading models to do this trading process. Well, what happened was several firms got together and figured out the core logic of their trading. And what they then did was they engaged in activity that at the end of it destroyed long-term capital management and jeopardized the entire financial system of the global economy. So the Fed and all these other entities had to get involved to try to unwind those positions to allow everything to work smoothly. So this is an example of how you might have the sharks, in this case very large firms, that go to battle with each other, but the battle can show up and result in very strange things happening that you did not expect to occur. And so a lot of the investment models, et cetera, that are built depend on the markets working in a certain way. What they don't take into consideration is that there are some smart people who can figure out what's going on and how to destroy those models as a way to make money opposing the trades that are out there. There's one other example I wanted to bring up that pops to mind is that there's a company called Goldman Sachs, and Goldman was sued because one of their tasks is to identify good money managers and introduce those money managers to large investment houses to work with. Well, Goldman raised $3 billion for a company that's a hedge fund that's specialized in shorts or shorting stocks. During the crash of 2008, something strange happened, which is Goldman raised $3 billion for this fund, and then that fund did a short position in a company called overstock.com. Now, while the rest of the market was crashing, Overstock's price kept rising. So basically what happened was that Goldman was sued by that hedge fund because what they argued was that there are certain covenants, meaning if you're a hedge fund and you lose a certain amount of money, you're immediately wiped out and cashed out by the entities that you work with. And this is done to avoid it being a complete loss. So one other way you could discuss this is to basically argue that it's an example of a short squeeze. So right now, there are large numbers of hedge funds that monitor other hedge funds to determine when the stock price perhaps of the portfolio they have moves against them dramatically enough that they're violating their covenants. And once those covenants are violated, they go out of business. So can certain firms help those covenants to be violated, therefore putting those companies out of business, and therefore those funds make a great deal of money? So this is another example of how sharks, might go on the attack against each other. The final element of this I wanted to introduce is an idea called front running. So for example, you have an investment portfolio yourself, but you also have one as part of your retirement plan. Well, it turns out that when those monies are being invested, so right now we're in the first week of July or end of the first week of July. At the beginning of each month, there's a certain amount of money that comes in around the globe from a whole bunch of entities that have to be invested. So when a fund, let's say Fidelity, decides that, hey, we got our allocation of capital that we're investing for retirees, we need to invest that. One of the things they're going to do is invest in stocks. And when they buy stocks, they may end up buying companies like Tesla and buy 100,000 shares in one pop. Well, the problem with that is that when you buy that many shares, it causes the price to change. So one of the techniques people have used over time is to allocate different groups of shares, or they might buy in small quantities over time rather than buying it all at one time, as a way to prevent the market seeing where they are, and they can get a better price in the process. Well, one of the reasons that they do this process is a concept called front running. What that means is that, let's say I'm Fidelity, or let's say T. Rowe Price. I want 1 million shares of Tesla, and I have the money for it, and it's in our allocations. Everything is set to go. Well, if I go to, let's say, Goldman Sachs, or in this case, let's say Morgan Stanley, and say to them, I need 1 million shares of this. Please buy that for me in the next, let's say, 4 or 5 days, week of time in business to ensure we don't go over prices. Well, once it's known to Morgan Stanley, what they could do is actually call someone at another firm or former colleague and say, hey, we've got 1 million share order that has to go through. So right now, I'd encourage you to buy this stock because we have to buy it. Well, that entity will go out and pick up 1 million shares and wait until the order that I just described to you will go through. And once that order goes through, they make a killing because they knew the shares were going to get purchased and in general what the price was. So now they get to sell those shares back to the back to you, the buyer, but you've been front run, which means your cost may be 3 to 5, maybe even 10% higher than it would have been had you spread those purchases over a broader number of firms. And this is one of the reasons why I encourage you to have at least 2 firms that you do business with, maybe 3 if your portfolio is large enough and you're doing enough trading, because what will happen is, particularly for the discount brokers, the order flow of orders that you're doing is being sold to larger firms. And when they see large orders going by, particularly on options, but somewhat on stocks, you'll notice that they will actually give you, when you do a market order, they'll give you a worse price than you could have gotten because they know for sure that you're going to be buying those shares or selling those shares or whatever the activity may be, you're getting front run in that situation. Now, I could go on to countless examples of this, but the general idea is it can be very dangerous trading, particularly if you have a larger portfolio, because of all the techniques that can be used by Wall Street. If you really want a primer on this, there's a book called The Flash Boys, and I think I'm going to add it to my list of books I recommend people read, because The Flash Boys is actually about the fact that front running as an idea has been legal for a long time, but there have been new creative ways that have been found to actually engage in front running. The latest one in the case of Flash Boys was they actually showed how you have an ability via computer technology to front run trades and make great money in the process. And the regulators didn't really realize what was happening, but finally people who were overpaying for everything realized what was happening. And there's a book about it, and there's a bunch of changes that were made to allow those investors to sort of get a better deal, if you will. So the thing that I wanted to focus on at the tail end of our show today was sort of Elon Musk versus the sharks. As you may recall, if you've been trading or investing in Tesla for quite a while, about 2 years ago, Tesla was in doubt about whether or not it would stay in business or go bankrupt. And there are a number of firms that had a process where they provide negative reports about Tesla. They put negative reports in the news about Tesla. And the idea behind it was that as those stories got out and those stories started to be researched and considered by investors, it was lowering the price of Tesla. So Tesla had certain loan covenants where the stock price had to stay above a certain level for it not to be in jeopardy of going bankrupt. And that's an example of how the sharks are swimming and under an attack protocol when it comes to Tesla and other firms. But one of the things Elon has talked about a lot over time is that he feels that some of these rules regarding options and some of the other techniques used to undermine the operation of a company should be illegal, or the SEC should do a better job of policing it. Now, I have to say that I'm impressed by Elon by the fact that he understands the ability of Wall Street firms to potentially destroy a company, as we've described. Now, the issue is that pops up here is that in the case of Tesla, Elon has made some mistakes that resulted in the stock being down a little bit, but one of the miracles of Tesla has been its ability to navigate the shark-infested waters successfully to become as big a firm as it has. And I would say the biggest coup that he pulled off was negotiating a Chinese deal that in essence doubled the value of Tesla's shares, has doubled the value over time, but it stabilized the underlying operations of the company and has allowed it to thrive. So, this development was one of the issues that a lot of long-term shorts or entities that predicted Tesla's fall in value did not anticipate. And it came back to bite them because all of a sudden you have all these cars being sold in China in an environment where there's a large number of vehicles that are in demand. And so all of a sudden Tesla's market value doubles easily. And right now with the Chinese goal, from our analysis, of about 4 million Teslas being sold in China by 2025, I think that this is one of the key pillars of the forecast by the analysts that want Tesla to do well as to why the stock price is currently where it's at and why it's continuing to accelerate going forward. So the final component of the shark analysis I wanted to do is we've done a number of shows about a concept called the Friday pin. So what the idea is that every Friday there are options that expire. And if you have enough money and enough technique, you can actually move a stock price 5, 10, 15 points in any direction you want by executing those techniques. The question you're asking is, now wait a second, if you can do that for 1 or 2 days, why don't you do it for a week, 2 weeks, 3 weeks, a month? Well, that's entirely possible. You could do it on smaller firms, but Tesla's market cap is actually pretty big. And so it takes a lot of capital and technique to execute this. And this is why we argue that The pin process is usually Thursday into Friday for Tesla stock. So if you watch the stock price, the sharks are engaging in a pin process where they pin the stock price below certain target prices, and the goal there being they make a ton of money, causing a number of options at those strike prices to expire worthless. So one of the question marks, and huge, and there's a number of them that are going to emerge from this, is like, when do they do and do not execute pins? Well, the problem that happens is that when there are large numbers of investment managers that are trying to get into a stock, we're, call it 8 business days away from Tesla's announcing their earnings, we end up in this position where, remember the investment funds that are buying millions of shares? Well, those guys have so much capital and they have to spread their purchases over time, that you can end up with large amounts of buying happening even while people are trying to execute a pin. And so this is an example, theoretically, where big sharks on one side are going against bigger sharks on the other, and the biggest sharks tend to win here because they just have more capital and they can deploy that capital to acquire shares, and the reduced number of shares that are available causes price to rise. So there's a whole bunch of pushes and pulls here that are going on. Another interesting stat that lurks for this whole issue is the fact that General Motors and Ford, for example, have almost no sort of hold or sell the stock, while only half to 60% of the investment managers who recommend stocks are giving a buy signal for Tesla currently. So part of this is the fact that, yes, Tesla limits the information handed out, so it makes it harder for the analysts to have all the data they need to define what they're doing. But there's also a phenomenon there where there are certain firms that are paid to produce negative research, and that research supports the ability of certain firms to make a killing as they sort of, if not long-term damage the price of the stock, short-term do so. So I hope the goal of this was to really give you a flavor for, well, what does it mean to have sharks attacking each other versus attacking smaller investors? Smaller investors may be buying call options a few at a time. Big firms would buy them in large numbers. But the whole idea is that when the big firms, they can be battling each other, they can be going after the small individuals. There's a whole number of ways in which this can all be happening. So I look forward to questions because it definitely influences what we produce in terms of shows. You might want to go back, and I think I'll put a little pin in above us, and look at some of the shows we've done on the Friday pin process, and then the Monday trading that comes after Friday pinning is another way to understand how the shark process might work. Just a reminder, we have a few SpaceX shares if there's interest. We also want to encourage you to like and subscribe if you enjoy the show, and join us on Patreon if you'd like some helpful daily trading information as your trading portfolio daily. I also next wanted to get into our health tips. The first is core training. Highly encourage you to consider it. It's been awesome for me, helpful on my back pain, etc. issues. As you can see, I'm sitting on my Brompton, getting in at least 20 minutes to a half hour bike ride every day. Also wanted to encourage you to consider no more than a small salad prior to lovemaking, which allows the blood flow to extend to your entire body rather than just to your stomach to digest that large meal. And then we have a number of others. For example, don't go to bed within 4 hours eating, minimum 2 to allow the food digest before you do so. These are all tips that we have on our list that you might want to consider. At any rate, this is Greg for Teslafaninsight. Tschüss German, au revoir friends, Lehitrot, Hebrew, Hoda, Hafez, Farsi. The last note I wanted to make is that there's a show called Car Talk that I enjoyed when it was on the air, and I'm going to start a process of trivia questions with a Teslafaninsight t-shirt as the winning prize. So the question is, for the day is, there's a term called a dead ringer. And if you know what a dead ringer is without looking it up, you're eligible to win a t-shirt. And in our next show, we'll actually explain what a dead ringer is, and we look forward to what your guesses might be. Have a great day. By the way, this was contributed to our show as an idea by Neil de Grasse Tyson, and I think it's an amazing little factoid. Have a great day. Bye for now. Thanks once again for joining us. This is Greg for Teslafaninsight. Please note the dead fish on the beach here. They're trying to collect it up as quickly as possible, but the problem is that the red tide continues to kill off a large number of fish here in the Tampa Bay area.